In this session, let us see and discuss about the book value of equity shares, then market value of equity shares, and after that we will see return on equity, cost of equity, and investors required return. Okay. First, let us see what is a book value. Book value of a firm is calculated by subtracting the liability from the asset of the firm. Okay, so total assets minus total liability will give us the book value of a firm. So when the net income increases, further increases the retained earning, which will increase the book value of a firm. Okay, so that is about the book value. Now we will see the market value. What is the market value? Market value is the total price or value of the outstanding shares that a company or a firm carries. Okay, the total share price that is outstanding in the market, that gives the market value on which the investor has got expectations to get the better return and better result out of it. Okay, so that gives us the market value of a firm. Now we will see what is the this return on equity, how it is calculated. Return on equity is calculated as by net income divided by average of the book value. Okay, net income that is available to the common shareholders, and book value that is also that will be available to the common shareholders. Okay, which doesn't include the preferred shareholders. Now how the average book value is calculated? Suppose we are calculating the return on equity for this year. So book value of this year plus book value of previous years divided by 2, it will give us the average book value, and net income divided by average book value will give us the return on equity. Okay, so that is about the return on equity. How cost of equity is calculated? Cost of equity is calculated when the share it is calculated by the returns, the equilibrium returns of the company divided by the share price of the firm. Okay, so when it can be calculated either by dividend discount model or the capital asset pricing model. Okay, so when the share price of a firm increases, then this cost of equity reduces, and when the share price reduces, then the cost of equity increases. Okay, so that is about the cost of equity. Now we will see the investors required return. Investors, when they carry a firm or company shares, they also calculate or estimate the rate of return. Okay, the rate of return, and compared to that of the minimum return that they can expect. Okay, and when their estimation of return increases beyond their minimum return, that means their investors return are on a positive side. Okay, so because investors, when they carry a certain number of shares or stock, they also carry a risk whether the share price will go up or down. When it goes up, certainly they are on an advantageous position. When it goes down, then their return also return getting positive return hope reduces. So that is how the investor return is calculated. So that is about it for the today's session. We saw the market value, book value, cost of equity, and this investors return, and also we saw the return on equity. So while calculating the return on equity, suppose the book value. Okay, book value, we should not always the analyst has to go even further to calculate or to examine the book value. Suppose the book value, it has reduced. Okay, it has reduced, but and which has ultimately given the return on equity a good figure. But when it will be examined, it will be found that because the company has taken certain debt, okay, so the return has increased, but it is a negative thing. So the analyst has to see. That is about it. Thank you very much.